Today I'll be talking about Diageo. It's the world's largest international spirits company. It's a 39 billion sterling company, market cap in dollar terms of $51 billion. The company is based and listed in London. It was formed back in 1997 with the merger of Grand Metropolitan and Guinness, but some brands date back to the 17th century. I'll walk you through the company following this path. First, I will speak about the spirit sector, then the company itself, some risk to our equity story, and last but not least, valuation. Let's begin with the sector. The spirit sector is part of the broader alcoholic beverages sector, which is also part of the food and beverage industry. Alcohol is dominated by beer and spirits. Beer leads in both value and volume, but alcohol dominates in value per volume terms. Wine includes reds, whites, rosés, and sparkling. It's a category that's been losing share lately because of reds mainly, but sparkling, on the other end, continues doing pretty well. The industry moves with GDP growth. It's been growing 2% a year over the last 2 decades, and important to note, it's part of discretionary spending. The spirit sector, specifically, spirits are distilled alcoholic beverages with high alcohol content. There are different kinds of spirits, white and browns. Whites are those, in a very simple way to define them, are those that go from cereal or potato to bottled in a few days, while brown, or also known as dark spirits, take years maturing in barrels. There are many local international spirits. The most international, well-known are the likes of whiskey, tequila, rum, gins, brandy, and cognac, while other categories like Diageo and Cachaça are very important in China and Brazil specifically. The share of alcohol, of spirits on the total alcohol market, it's 10% in volume, but 33% in value. It is a fragmented market where top 10 players make close to or even less than 20% of global sales. And the consumption venue is also important to understand here. 70% is off-trade, which is at home consumption, bought in supermarkets, liquor outlets, or other retailers. And 23% is on-trade. That is consumed in restaurants, bars, pubs, and clubs. This is a very important channel to drive demand and trends because to many people, barman recommendations matter. Important also in the spirits are the IMFL, Indian Made Foreign Liquors, which are whiskeys, rum, gins, and vodkas that are made in India. Is very important in terms of volumes for the industry. So how we got here? Actually, it was by chance. We were requested in 2017 to have a look at a non-listed player in the industry. And we found very interesting fundamentals, but concluded valuations were demanding at the time. The industry was running a bull market driven by consumers in good health, growth, profitability, and sector consolidation. After the GFC in 2009 to 2019 period, the share price of the 4 main listed players delivered a strong CAGR of 13%. In 2020, with the COVID shock, we thought our opportunity may come, but the industry bounced back quickly and very strongly. During the next 3 years, it was a history of 2 halves. First half, it was beneficiary of the unexpected COVID trade. Due to social distancing, consumers were at home looking what to do with their pile of savings. So began buying expensive bottles of spirits, and they were also e-learning via Zoom how to prepare cocktails to please themselves at home. Second half of this period, when inflation came, producers were able to pass inflation to consumers. who were still enjoying large savings and healthy disposable incomes and were displaying some sort of revenge attitude after months of lockdowns. They were going out to restaurants, shows, and traveling. But the music began to stop by late 2023. And since then, the volumes are falling and prices do not grow that fast. Wholesalers and big retailers are taking a long time to digesting inventories, and valuations began to collapse. Today, the sector is feared as the new tobacco, is considered by many as a dying sector. Since we follow the sector back in 2017, it was gone from sunrise to moonlight. Let's see some key trends. Let's begin with the headwinds. Moderation is a key one. Consumers are increasingly aware of well-being and health concerns, and the number of consumers switching regular drinking choices to low non-alcohol and low-calorie options is increasing every day. There are concerns on potential cannibalization effects of no low alcohol offerings on the mainstream brands. And the arrival of GLP-1s was not well received by the overall alcohol sector. Regulation is also pressing here and there. Governments look for ways to constrain alcohol abuse. For example, this very year, the regional government of Maharashtra in India considerably increased excise taxes. And here in my country, in Spain, the maximum alcohol level for driver has been dramatically reduced, close to zero level. Gen Z, which are those guys aged from 18 to 27 years old, or in the US, 21 to 27, legal drinking age, have a different relationship with alcohol compared to previous generations. They show higher levels of abstention, moderation, and are much more open to trying new categories. They are overrepresented in white spirit-based cocktails, no and low alcohol, ready-to-drinks, low calories, and alcohol-adjacent beverages, those that contain cannabis. They got late because they should have been recruited during COVID years. Macro issues. 3 years of inflation have eroded disposable incomes, and the piggy bank built in COVID is largely gone for low-income consumers. And as we speak, mid-income consumers begin to feel the pain. Consumers are buying less and trading down. It is evident in major markets like the US and Europe, but also in China, which has also met with the government's no-show-off policy, fighting the display of wealth and extravagant luxury, which is driving consumption from the on-trade to the less profitable off-trade channel. On inventories, the 2020-22 party led to a hangover. Wholesalers and large retailers built large stocks, extrapolating recent trading at the time, and sell out to consumers did not went along. They began to cycle it back, but in H1 2025, seems to be a period of high sellout driven by driven by fears to tariffs. So the issue to our end in inventory hasn't been solved yet. Tariffs added injury to pain, not only because it's a favorite word of President Trump, but it's also top of the list on EU-China relationship. China retaliated EU's cognac and brandy after tariffs imposed by the EU on EVs and batteries from China. And it's very important for the industry because, for example, for cognac, which is very important in the premium end of the market of the spirit sector, the two most important markets are China and the US. Now in China applies a 10% most favored nations tariff. And if a minimum price is not met, they apply round numbers 28 to 35% additional tariff, while the US applies a 15% tariff for cognac which is produced in France. Europe. Scotch and gin, UK businesses. First, market number one is the US, and they are now paying a 10% tariff. Vodka, again, market number one is the US, but it's produced in the EU and UK. Well, they are now pay a 10% tariff. In the other end, well, India is reducing for UK spirits, the tariff for UK spirits to only 75% and will progressively reduce to 40% for Scotch and gin, and only 100% for Bourbon, American whiskey, and apply 150% tariff for everything else. Given all these headwinds, the sector has suffered as a consequence. So this is data for the very important US market. In 2023, it was shown the first volume decrease in 30 years, and 2024, and it's not here, but 2025 has not been better. Well, our analysis leads us to conclude there are structural and circumstantial issues here. Let's split them. Beginning by the latter, we consider macro challenges and high inventories to be transitory headwinds. For sure, they will continue to impact trading during the coming months, but they will go and come back later. So it's the name of the game. So there is some sort of cyclicality here, of course, because demand depends on the health of the consumer, which depends on macro. And the inventory stuff will solve itself and will come back several years in the future. Tariffs are in the middle ground. The situation has calmed down after agreements between the US government and its counterparts in the EU, UK, Mexico. Cognac is flowing back to Chinese shelves since a few weeks ago, but it's still not clear if it's fully done. Let's now talk of structural challenges. It's true that consumers' health consciousness has increased, but it opened a landscape of new opportunities for the sector. Consumers are trending to less but better drinking, which favors premium products with better value mix. Concerns on potential cannibalization effects of no and low alcohol offerings on mainstream brands have dissipated, as the main segments losing out share to them have been other non-alcoholic beverages, such as soft drinks and water. And this is helping the spirits industry to broaden its consumer base, and as it is now presenting more occasions. For example, you now can take a spirit on lunchtime, not only at night, at a night party. While it's not 100% compatible, Anheuser-Busch Bev, beer worldwide leader, discloses that 2/3 of their roughly no alcohol offering comes from new consumers, and only 1/3 eats into beer. Spirits have been playing an increasing role in ready-to-drink battleground, and the positive momentum is expected to continue in the foreseeable future. The growing ready-to-drink category is seen as an affordable alternative to spirits, which is good in this environment. It is still a local, lower entry barrier market, but large players are growing fast. Consumers' demand and changing tastes are stimulating product innovation, and sector players are keen to develop variations around their core brands. And when they identify a third-party brand favored by consumers, they are willing and able to acquire it. Big players can exploit innovation and no low alcohol approach at a scale. They have the resources, they have the logistics, and the drive power to build brands, increase awareness, and drive demand. Finally, on Gen Z, they got late, but they are finally here. According to IWSR data, alcohol penetration in this cohort has finally caught up with older generations. Now we have gone through the bad and ugly. Let's talk about the strong fundamentals of this sector. First is demography. Emerging markets provide for growth. A combination of growing population and upper, middle, and high-income household is a very strong tailwind to the sector. Women participation is another driver. The industry has put attention on women, broadening the offering, not only of low alcohol, but also flavor spirits and ready-to-drink cocktails targeted to women. On premiumization, for over a decade, spirits consumers globally have been moving towards higher quality. Premiumization has been a significant tailwind to brand owners. What is called the premium and above segment, which is defined as 75 centiliters bottle with a sell price of more than $22.5 at retail shop. This segment improves price mix, margins, and returns because of the higher price and the flat rate excise tax based on alcohol level in most markets. Since 2023, the premium tier lost momentum with volumes declining but holding up on value. However, the super premium and above tiers, which are bottles with a sell price of more than $30, prove more resilient. Premiumization is expected to continue playing a key role as it is based on two solid grounds. One is the general consumption of premium products is closely linked to consumers' aspirational lifestyle. As population and middle class expands and disposable incomes improve, the consumption of premium products increases, and the pool of consumers is expected to continue growing in India, China, and neighboring APAC markets. And two, premiumization also sits well with mature Western markets trends towards drink less but better. Well, on innovations, I've already touched on this. By the way, the first image in this slide is a picture from a friend's party last very Friday. Most of the people were women, and to enter the party, you had to take a shot of a Smirnoff Vodka Spicy Tamarindo. It is the first time I saw this colorful bottle clearly made to women. Here's data from the key US market in volume terms, and it is evidence how super premium and above has outperformed during the last 20 years, gaining share of volume of its own category at the expense of standard and value bottles. Nonetheless, it is also seeing how it is suffering lately as a consequence of both lower disposable income and high inventories. Let's turn to modes inherent to this business. Scale. Scale translates into cost savings mainly in two ways. First, greater bargaining power with suppliers over raw materials and distribution. And secondly, through a greater dilution of fixed costs, including administrative, marketing, and logistics, which are spread over a greater number of units. All this makes for high operating margins and the ability to invest more into growth, marketing, distribution, aging inventories, and innovation, generating a virtuous circle, which is very difficult to match by smaller competitors. On aging, there is a scarcity value to aged spirits. You need deep pockets to fund barrels to be sold in many years from now, and because of the evaporation of the alcohol in barrel over time, known as the angel's share. If you want to sell 18-year-old aged whiskey in 5 years from now, you'd better have begun to age 13 years ago. The longer the maturing process, the higher the scarcity value and the retail price. And consumers also perceive the aging process to improve the taste. And brand loyalty tends to be higher in consumer products categories with real product differentiation and better quality. So it's very important mode in this industry. Brands play a key role in the broad alcoholic beverage industry. Consumers associate brands with specific living standards, lifestyles, and personal experiences. Brands increase the power of price fixing, which allows producers to better withstand falling volumes in down cycles, as we've seen in the last 2 years. And at the same time, keep new competitors away. Furthermore, building a brand from scratch entails a significant investment effort. I cannot guarantee positive end results. So that's why high valuations are paid for in M&A transactions when there is a strong brand in place. Let's turn to the company itself.